You know, when you want to take the temperature of the global economy to really see how things are doing out there, it is so tempting to just look at the tech giants.
Oh, absolutely.
Right, like you look at the stock tickers for companies building the latest AI models or, the massive banks processing credit cards. But if you really want to know what is happening in the physical world, you don't look at the software.
No, you really don't.
You look at the invisible glue holding the world together. Literally, you look at welding.
Yeah, I mean, it is the ultimate leading indicator. You cannot build a skyscraper, manufacture an earth mover, lay a new pipeline, or honestly, even keep a factory running without joining pieces of metal together.
Exactly.
So when welding slows down, the physical expansion of the global economy is slowing down. Period.
Which brings us to our mission for today. Welcome to today's deep dive. We are looking at the Q1 2026 earnings report from Lincoln Electric Holdings, Inc.
A fascinating one to look at, too.
It really is. And we are pulling directly from their official Q1 2026 earnings release, their presentation deck, and their financial highlights. Our goal for you today is to decode what this specific 130-year-old industrial giant's record-breaking quarter actually tells us.
Right.
We want to look at what it says about inflation, corporate pricing power, and, well, the real-time health of global manufacturing.
And setting the stage here really requires looking at Lincoln Electric not just as like a singular financial entity, but as a true global bellwether.
Yeah, they're huge.
Massive.
Yeah.
We are talking about a company operating 71 manufacturing and automation facilities across 20 different countries. They serve customers in over 160 countries.
Wow.
Yeah, they touch everything from heavy industry to general fabrication. And what is so fascinating about these Q1 results is how they offer an absolute masterclass in navigating an incredibly complex inflationary environment.
Like a survival guide.
Exactly. It serves as a real-time study in corporate survival strategy for 2026.
Okay, well, let's unpack this, because if you just glance at the headline numbers in this report, you might think we are in the middle of, like, an unprecedented global manufacturing boom.
Right. The numbers look incredible at first glance.
The top-line numbers look absolutely fantastic. We are talking record net sales for the first quarter of $1.12 billion.
A billion with a B.
Yep, that is up 11.7% year over year. They hit a record-adjusted EPS of $2.50, which is a massive 15.7% jump.
Huge.
And they maintained a remarkably strong 16.9% adjusted operating income margin.
Yeah, I mean, on paper, it paints the picture of a flawless victory. The company is generating significantly more revenue, earning more profit per share, and, keeping their margins incredibly stable despite all the macroeconomic turbulence we've seen globally.
But as we dig into the sources, the story of how they got there becomes much more complicated. To visualize this, imagine a trip to the grocery store. Imagine you are doing your weekly shopping, you get to the register, and you look at your receipt. Your grocery bill went up by 11% compared to last year.
Ouch. Yeah, we've all been there.
Right. But then you look down in your cart and you realize you actually brought home fewer bags of food than you did previously.
Right.
Your bill went up, but your physical volume of goods went down.
That analogy perfectly captures the underlying reality of these net sales figures.
Because when we break down that 11.7% sales growth, the actual volume of products Lincoln Electric sold, the physical tonnage of welding wire, the number of actual machines was down 2.6%.
They literally shipped less stuff.
They shipped less stuff. So I have to push back on the narrative of a booming quarter here. Like, is this actually a victory, or is this simply the math of inflation padding the stats and, masking a fundamental industrial slowdown with higher price tags?
Well, it is a vital distinction to make, but this isn't just passive inflation padding.
Oh, right.
No, what we are observing is a textbook demonstration of industrial pricing power. Yes, the physical volume was down 2.6%, but a massive 10.4% of that revenue growth came purely from price increases.
Wow. So they just raised prices.
Exactly. They successfully passed those rising costs directly onto the market without suffering a catastrophic loss in demand.
So they looked at the record commodity inflation across their supply chain. They factored in their own higher employee and operational costs, and they simply raised their prices to cover it all.
Yep.
And the crucial part is their customers still paid it.
And you see that strategy spelled out directly by CEO Stephen B. Headland in the report. He specifically highlights, quote, disciplined cost management as a primary driver for the quarter.
Meaning what, exactly?
Meaning the company recognized that they couldn't control the macroeconomic headwinds shrinking their volume.
Right.
They can't force someone to build a bridge faster.
True.
But they could control their pricing architecture and their internal cost structure. The result of that discipline is a 17% incremental margin.
Meaning they grew their operating income faster than their sales grew.
Precisely. It is a victory of margin management over sheer volume. They are proving that even if the industrial pie is getting physically slightly smaller, a company with enough leverage can still take home a much richer slice.
Right.
They're protecting their profitability at the expense of top-line volume growth.
Well, if you think a 10% price bump across the main business is an aggressive display of pricing power, you have to see what happens when they get hit with a true commodity shock.
Cool, yeah.
Buried in this report is perhaps the most extreme, mind-boggling example of this dynamic playing out in real time. I literally couldn't believe the numbers in the Harris Products Group segment.
The Harris Products Group results are a fascinating anomaly in this report.
So Lincoln Electric has 3 main segments, and the Harris Products Group is one of them. In Q1 2026, this specific segment saw a massive 42.3% year-over-year jump in net sales,
Unbelievable growth.
hitting $188.2 million. And their adjusted EBIT margin soared by 330 basis points, which is a 3.3% jump to hit 21.2%.
Right.
If you just read that in a vacuum, you would assume they invented some revolutionary new product that the entire world is fighting to buy.
But the underlying reality is entirely tied to the volatility of the commodities market.
Okay, let's break down that 42.3% sales jump. Volume, the actual amount of products sold dropped 1.0%.
Less product.
Exactly. But the price impact on sales, that was a staggering 41.4%. And the specific culprit mentioned in the sources is metal costs, primarily silver.
And this is a crucial mechanism to understand when analyzing industrial supply chains. It demonstrates how raw material volatility, in this case, silver, which is used heavily in the specialized brazing and soldering alloys that the Harris Products Group manufactures, directly inflates the top-line revenue numbers.
So they have to buy a lot of silver.
Yes. And when silver prices skyrocket globally, the price of the final manufactured product skyrockets proportionally.
Here is where I get tripped up, though. If the cost of the raw silver is skyrocketing, wouldn't that pressure their profits?
You would think so.
I mean, they have to buy the expensive silver on the open market to make the product. Yet their margin went up by 330 basis points. Are they gouging their customers?
It's a fair question.
Are they using the rising cost of silver as like a smokescreen to hike prices even higher and pocket a massive difference?
Well, that would be the logical assumption. And we
Well,
definitely see that behavior in certain consumer sectors.
Yeah.
But the report explicitly contradicts that narrative here.
Oh, it does?
Yeah, the sources note that Lincoln Electric maintained a strictly neutral price-cost position in this segment.
Wait, so they only raised the price of their finished goods by the exact dollar amount that their raw material costs went up?
Exactly.
They didn't add an extra markup on the silver itself. It was just a dollar-for-dollar pass-through.
Yes. They passed the cost of the silver directly through to the buyer. No extra markup.
Then how on earth did their profit margin jump to 21.2% if they aren't marking up the silver?
This is where the mechanics of SG&A leverage come into play.
SG&A.
Selling, general, and administrative expenses. So the structural fixed costs of running the business.
Okay.
Those numbers don't magically increase just because a precious metal got more expensive. The corporate salaries, the facility leases, the software licenses, those stay relatively flat.
Okay, I see where this is going. The underlying business costs are anchored.
Exactly. Because the cost of silver exploded, the top-line revenue number, that $188.2 million, also exploded. The revenue pie became massive. But those fixed corporate costs stayed essentially the same.
Right.
So when you calculate the profit margin at the end of the quarter, those fixed costs represent a much, much smaller percentage of that dramatically larger revenue number.
Wow. That is a brilliant piece of accounting reality. So the business didn't necessarily get 3.3% more efficient at manufacturing brazing alloys.
No, not at all.
The factory floor didn't undergo some miraculous optimization. The math simply worked out in their favor because of the sheer scale of the raw material inflation, diluting the impact of their fixed overhead.
It is a mechanical margin expansion. And it perfectly highlights why any serious investor or analyst has to look past headline revenue numbers and really understand the commodity inputs.
Because it works both ways, right?
Exactly. If silver crashes next quarter, that revenue number will plummet, and the margin will compress, even if the underlying health of the business hasn't changed at all.
Okay, so we've seen how they manage extreme pricing scenarios in a segment dominated by a single volatile metal. But let's look at how this economic reality is playing out geographically. The global map they outlined shows that things aren't exactly smooth everywhere.
Right, the report breaks the core business down into Americas Welding and International Welding. And the contrast between the two provides a very revealing heat map of global industrial health.
So starting closer to home, Americas Welding brought in $706.2 million in sales, which is an 8.1% increase. And again, this was heavily led by price adjustments.
Right.
But there is an interesting glimmer of hope on the volume side here. The volume declines are narrowing, and the report specifically notes they are seeing modest volume growth in consumables and automation.
Which signals that in the Americas, the early-stage industrial recovery management mentioned in their presentation is actually materializing.
Things are picking up.
Slowly, yes. Customers are consistently buying the consumable materials, the actual welding wire and flux that they need to run their daily operations. Furthermore, the investment in automation tells us that American manufacturers are actively spending capital to offset their own chronic labor shortages and rising wage costs.
Right, they are buying robots because they can't find welders.
Exactly.
But then we flip over to international welding, and the picture gets significantly darker. Sales were $227 million, which is only a 3.6% increase. But if you look closely at the product mix, their organic sales actually declined.
Yet, volume dropped to a rather severe 9.9% internationally.
And the report points to two main culprits for this drop. First, they had a really tough comparison to a historically strong prior year in their international automation business.
Right, tough comps.
But second, they cite an estimated $5 million negative impact strictly from the Middle East conflict. The only thing that kept the international segment's overall growth positive was a 7.2% benefit from their recent acquisition of Alloy Steel, or ASI.
And that $5 million hit is a perfect illustration of the geopolitical vulnerability inherent in global manufacturing today.
But wait, how exactly does a localized conflict in the Middle East shave $5 million off the top line of a welding company headquartered in Ohio? Like, what is the actual mechanism there?
It comes down to the fragility of international maritime logistics. When conflict erupts in that specific region, it immediately threatens the Red Sea shipping lanes and the Suez Canal.
Right.
That is a primary artery for global freight. To avoid the risk, commercial shipping lines reroute their massive container ships around the Cape of Good Hope at the bottom of Africa.
Which adds weeks to the journey.
Weeks to the journey, and it burns millions of dollars in extra fuel. And it causes a cascade of delays. The product's Lincoln Electric ships from its manufacturing hubs simply cannot reach their international distributors or end users in the Middle East and surrounding regions on time.
Oh, I see.
Projects stall, inventory gets trapped on the water, and localized demand temporarily evaporates because the supply chain is functionally frozen.
So it's literally just stuck on a boat.
Yes. That geopolitical friction translates directly into a missed $5 million in recognized revenue for the quarter.
Which brings me to the single number in this report that really made me do a double take. We are looking at a quarter with record sales, record-adjusted earnings per share, and masterfully disciplined pricing.
Yep.
But then you look at the cash flow statement. Their cash flow from operations dropped 45% year over year.
It's a huge drop.
It fell from $186 million down to $102 million. If they are making record profits, why did their operating cash flow essentially get cut in half?
Well, when you see cash flow drop precipitously while net income is rising, the immediate place you have to look is working capital. And the presentation very clearly states this drop was driven by higher working capital requirements.
Specifically, they took a massive amount of cash and tied it up in inventory.
Right. The report phrases it as a, quote, temporary increase in inventory investments to support customer service levels. And honestly, this represents a profound philosophical shift by their management team.
But isn't hoarding inventory usually seen as a negative in modern lean manufacturing?
Traditionally, yes.
For the last 30 years, the entire mantra of the industrial world has been just-in-time deliverer to keep cash entirely free and warehouses empty.
In the pre-2020 world, yeah. Lean manufacturing was the undisputed gospel. You only ordered the steel the day before you needed to weld it.
Right.
But we are operating in a post-supply chain crisis era now. By deliberately taking their own cash and locking it up in raw materials and finished goods sitting on warehouse racks, Lincoln Electric is making a highly strategic choice. They are transitioning from just-in-time to just-in-case.
Just in case, meaning they are prioritizing resilience and reliability over short-term cash flow optics.
Think about their end customer. If a major fabrication plant urgently needs a specific welding wire to keep a multi-million-dollar production line running, and their usual supplier is blaming Red Sea shipping delays.
They will just look for an alternative.
Exactly. Lincoln Electric wants to be the supplier that can answer the phone and say, we have it in stock in the local warehouse right now.
So they are sacrificing a pristine cash flow number this quarter to ensure they don't lose a single customer to a stockout.
Precisely.
Because you can't successfully force a 10% price increase on a customer if you can't even guarantee the product will arrive on time. You have to buy their loyalty and their tolerance for higher prices with absolute reliability.
That's a trade-off.
They are using their strong balance sheet as a competitive moat.
Yeah, it demonstrates a management team that is optimizing for long-term market share dominance, not just trying to hit a quarterly cash flow target for Wall Street.
Okay, so having diagnosed the complexities of the first quarter, let's look at the 2026 crystal ball. How do these Q1 indicators shape Lincoln Electric's expectations for the rest of the year?
It's the most important part of the report, really.
Because this company's footprint is so broad, their internal forecast serves as a massive leading indicator for the broader industrial economy.
And the end market performance data they provide gives us a highly detailed heat map of where the global economy is accelerating and where it is hitting the brakes.
Right, because looking at their Q1 global end sector performance, you see an incredible divergence. On one hand, general fabrication is absolutely booming up in the high 30% range.
Huge growth.
Heavy industries are also growing up in the mid-single digits. But then you look at non-residential structural steel and transportation, and those sectors are down in the high teens. It is a massive contrast.
It really is a tale of two economies.
People are fabricating general goods at an explosive rate, but they aren't building massive steel structures or buying commercial transportation equipment.
What we are observing here is an economy that is humming in very specific fast-cycle pockets, but cooling rapidly in massive, capital-intensive infrastructure. And the dividing line between those two realities is the cost of capital.
The interest rates.
Exactly. Non-residential structural steel, which encompasses your skyscrapers, your massive distribution centers, your large factory builds, requires long-term capital commitment. You finance a skyscraper over years or decades.
Right. You need a massive loan for that.
And when interest rates are sitting at elevated levels, the math on those mega projects breaks down, and they get shelved or delayed. The demand for the structural welding required to build them simply evaporates.
But fixing a broken piece of agricultural equipment or building a smaller run of metal shelving or routine factory maintenance, that is general fabrication.
And general fabrication is often funded out of a company's operational cash flow, not through massive commercial loans. It is much less sensitive to interest rate fluctuations.
That makes total sense.
So the everyday fabrication of smaller goods is somehow defying gravity, while the heavy structural projects are bearing the full brunt of monetary policy.
Wow. Despite that severe split in their end markets, though, management made a very bold move in this earnings report. They actually raised their forward outlook for the year.
They did. They raised their net sales growth assumption for the full year 2026, from mid-single-digit growth up to high single-digit growth.
But the crucial detail is how they plan to achieve that upgraded growth target. Management is totally transparent that this growth isn't going to come from some sudden, miraculous explosion of volume. They assume the mix for this high single-digit growth will be roughly 25% volume and 75% price.
Which telegraphs that Lincoln Electric's management team firmly believes two things about the macroeconomic landscape for the rest of 2026.
Okay, what are they?
First, they do expect underlying demand trends to improve slightly over the course of the year that accounts for the 25% volume assumption.
Got it.
But second, and far more importantly, they expect inflation to remain incredibly sticky, and they are entirely confident in their ability to continue passing those inflationary costs onto their customers. That is the 75% price assumption.
They're basically betting the house on their pricing power holding strong.
They really are.
But they also flag some serious risks to this assumption in the fine print.
Oh, absolutely. They explicitly noted risks around the net impact of shifting trade and regulatory policies, broader economic and geopolitical headwinds, and the reality of continued inflation in both raw materials and labor.
So they aren't completely blind to the dangers.
No, They are projecting optimism, but they are clearly keeping one eye fixed on the volatility of the global geopolitical map.
So if we zoom all the way out, what is the real lesson here for us? What does this deep dive reveal? To me, Lincoln Electric's Q1 2026 isn't just a dry corporate earnings release. It is a real-world, gritty playbook for how major companies are navigating the specific economic realities of 2026.
It completely outlines the exact survival strategies required in this environment.
Right. You survive by aggressively enforcing your pricing power, ensuring you pass on costs before they erode your margins. You survive by protecting your customers from global supply chain shocks, intentionally hoarding inventory even if it severely dents your operating cash flow.
Yeah.
And you survive by relentlessly managing your internal costs so that even when the staple volume of your business shrinks, your profits can still hit record highs.
And that actually brings us to an incredibly important, somewhat provocative question for you to consider.
Okay, let's hear it.
We started this discussion by characterizing welding as the physical act of building the world, the invisible glue of the economy. Lincoln Electric just proved they can engineer record-breaking financial results, primarily by raising prices to match inflation, even as the physical volume of the goods they manufacture and ship actually shrinks.
Right, less actual steel and wire going out the factory doors, but significantly more money coming in.
Exactly. But if we extrapolate that corporate strategy to the broader global economy, how long can any industrial company or the global economy as a whole continue to grow its top and bottom lines if the physical volume of manufacturing isn't actually expanding?
Oh, wow.
If we are physically building less infrastructure, manufacturing fewer goods, and moving less freight but simply charging higher prices for all of it, are we looking at true, sustainable economic growth? Or are we simply witnessing the brilliant, highly managed inflation of a balloon?
Man, that is the multi-billion-dollar question underlying the entire market right now. If the invisible glue holding the world together is getting more expensive, but it's holding together fewer pieces, eventually something has to give.